Is gold going to soar or crash? Let's find out. First off, read this disclaimer carefully. We will look at a gold mining stock called Harmony. This is their website, a bunch of news. Let's also go to the About page. Harmony, a gold mining and exploration company, conducts its activities in South Africa and in Papua New Guinea, one of the world's premier new gold-copper regions. With 69 years of experience, Harmony is currently South Africa's largest gold producer. Here you can see some history and the board and executives. Let's jump into the charts. Let's get rid of that news. Here you have like the super long-term perspective, weekly data points going all the way back here to 1998. Something that you will notice is that there's been some huge moves in Harmony before. Let's measure this move here. That was like 412%. Then we whipsaw a bunch. And then we actually have a bit of a... Then we'd enter, you know, the bear market. Let's actually compare to the GLD. This is the gold ETF. Yeah, unfortunately we do not have that much history on the GLD. Yeah, but you can see that the GLD, it reached a high here in August 2011. And then we saw precious metals entering a bear market, and you know, it dragged quite clearly Harmony Gold with it. Let's get the percentages back. So it was a very deep bear market. So measuring from that high to that low, that was minus 97% plunge, which is obviously pretty huge. Let's zoom into the most recent developments, because if we do measure Harmony from that low here, that high, that's 722%, that's huge. To where we are now, that's 442%. To the recent high here, that was 712%. For all intents and purposes, it seems like this was the major liftoff, and we went from being in a bear market to now this looks like a bull market. The reason why Harmony is rather interesting is that we've seen a big pullback, but we found support at these expected support levels. Tons of history here, and we have already seen a rather impressive move. Like this, that's 58%. One of the challenges with a stock like this is that it is rather volatile. The percentage moves are big. This move here alone, that was 44%. If we measure the pullback from here to here, that was minus 37. Hence, this is really the jalapenos in your portfolio, the huge percentage moves. So that is just something you need to take into account if you are going to get into these gold mining companies. But looking at the chart, this looks like a nice rounding bottom, and if we look at the correlation here with S&P 500, it is 66%. What is more interesting is to look at the correlation with the GLD. Well, yeah, let's take the GLD. So with the GLD, we have an 86% positive correlation. Let's look with the GDX, which is the Gold Miners ETF. Yeah, 86%. That's a strong positive correlation, and that's something we would expect to see. Let's look at some of the moving averages. We've seen the 200 and the 100 week moving average. They've smoothed out, and yeah, the 100 week is positive. The 200 week, it's seen a bit of a pullback, but for all intents and purposes, this looks very constructive. Let's look at the daily data points. We are struggling a bit at resistance at the 50-day moving average here in green. And then we have two resistance levels above us, the 200-day and the 100-day. we definitively expect, you know, there to be some battle here. But as you can see, this stock moves very erratically, a bunch of pullbacks and rallies. Hence, this is one of those stocks that can be especially tricky to market time. Hence, to get the position here, you simply need to have a thesis. So if you are bullish, it might be easiest to just scale into it, because as you can see, it is just very erratic. Huge rally, huge crash, huge rally. The long-term picture from a charting perspective is in favor of the bulls, and beyond this company, there's many reasons to be bullish on gold. So let's actually look at the GLD, the gold ETF. Here you can see a multi-year rounding bottom, a very nice rounding bottom, and we've made tons of progress. And especially if we break out above these levels, that would be very huge. That would be, then you could see a very aggressive move. All of the actions of the central banks and the uncertainties in the world relating to the debt, that is also bullish for gold. There is a bit of a caveat, because something we recently saw was the crash in the oil futures, you know, the paper oil. Hence, it could be prudent to have exposure to real physical precious metals as well, because there are these inherent problems with paper investments that's become very salient recently. Again, the chart of gold looks good. Let's look at some fundamentals. Here is Harmony Gold Mining. The stock is considered to be overvalued. Market cap $1.6 billion US. Beta is really low. For, you know, this is super low. I mean, the beta of the overall market is 1. This is way below. Let's look at some of the analysts. It's you know, it's a bit of a mixed bag here. Especially recently, we have seen certainly an increase in analysts, because that here we just have 1. The recommendation rating is underperform. But if we go to Saks.com, they have a number 3 hold rating. But here is when it becomes interesting. They have an A value score, A growth score, and F momentum. And the industry rank is in the top 4%, 11 out of 253 industries. That's obviously pretty darn good. No dividend, the forward PE is 20. This is really an interesting company. Something I want to talk about now is super important, and that is some tips about investing. Basically the rules of the trade. This first point here is super important. Do not trade on a live account until you have successfully traded a demo account. This is super important. And if you want to try something new, let's say that you only have tried stocks, but you want to experiment with options contracts, then where should you do that? Obviously, you should certainly start in a demo account. I guarantee you, you will make some rookie mistakes when you do something new. It always happens. And this is where you want to make those mistakes. And one of the criticisms people have about using demo accounts, you know, paper trading, I mean, we're talking, you know, that kind of paper trading, is that it isn't real. You know, when you lose, it's not real money, but you can gamify it, okay? So if you can create some reward punishment system. Let's say that if you have a profitable week, then you will treat yourself to something that you like. If you don't, then you will not get that treat. You can easily gamify a demo account. And so increase your live trading if you succeed, but decrease if your performance declines. And of course, know the balance between what you do in a live versus demo account should depend on performance. The most important thing is to always keep trading, because that's how you can hone your skills and always be like, have the pulse on the market. There's been a lot of research that shows that you need 10,000 hours to master something new. This is super important as well. All of these points are of course here because they are really critical. Commissions, they are really the devil. If you are in a high commissions platform, just get out. Commissions are the worst thing ever. One of the things they do is that they poison your decision making, because whenever you have a trade in your account and you are on some high commission platform, then you will not really act, because you are constantly thinking, if I exit this losing position, then I will trigger commissions, and if I get back in again, then there will be new commissions. So yeah, commissions, just don't be on a platform. I mean, there's many no commission platforms now. You have, TD Ameritrade, they have gone into no commissions. Interactive brokers have very low commissions. And you also, of course, have Robinhood. In Europe, you have DeGiro. That's also low commissions, not zero commissions, but yeah, commissions, yeah, poisons everything. It's very important to be aware that technology is inherently reductionistic, meaning it simplifies a rather complicated reality. Hence, a way to counteract that is to analyze your investing prospects holistically. So look at the charts, look at the fundamentals, and look also at the things that are not that quantifiable. Like, what is the zeitgeist, the spirit of our times? Because that's the most powerful force. It's those hidden factors that are just the current flowing through the human psyche, which will naturally push a lot of money into certain industries. Let's go to the next point. Very important, respect trend signals. Only fight trends if you can move the market. Super important. And most people do not have accounts that are so big that when they put on a trade, they can decide the bottom. Treat markets like laboratories, wherein you can test your hypothesis scientifically. I think this is one of the most interesting ways to view the market. Because it is like a laboratory. You come to the market and you have a hypothesis. So let's say the hypothesis is that gold will go up. That is your hypothesis, and you put on a bullish position. However, if it moves significantly against you, then that thesis was invalidated. And by having this scientific approach, you will be drastically able to improve your success rate. Another thing is that diversification is the only free lunch. Look far and wide for opportunities. Study and learn from the great masters. There's tons of great books about this, like Market Wizards, very good content. Be honest about your strengths and limits. This can also be a major issue because most people in this space will be very upfront about their wins, their big wins, but any failures will not be talked about. This is disastrous because you will learn far more from your mistakes than your successes. Because of this, it is super important to always start with a demo account. Ideally, even when you are actively into live trading, I would still recommend to have a demo account. Because the demo account is where you can develop yourself more aggressively. Try new things that you don't know that much about. Always be willing to learn and improve. Here are the final points. Buy fear and sell greed. Plan your exit before entering the trade. That also enables you to have a more scientific and less biased approach. Remove losers and nurture your winners. And just because you have a losing investment, it doesn't actually mean that your theory as such was wrong. It's more about the timing, and timing is very, very important. Trading should be fun and rewarding. Invest like a custodian shaping the future. So I don't like this whole the simplistic approach many people have, where they just don't really care about what they are investing in. It becomes like they are trading like a machine instead of trading like a human, and I don't like that, because you are voting with your money. You are always making a political decision when you move money. That's very important. And this is something the super pros in the market, the most famous names, they fully understand that commerce is always political. Yes, Harmony Gold, very interesting company. Let's just quickly look at the S&P 500 while we are at it. Like that, and let's get back the SPY here on the correlations. No surprise, there is a 100% positive correlation between the SPY and the SPY. It's a bit interesting, well, very interesting, because you see that this is the S&P 500 ETF, these are the daily data points. We recently tested the 50-day moving average. We were rejected. Today it will be super important to see whether we get above this 10-day moving average. It's currently a quite clear resistance level. It is very important for the bears to make sure that bulls do not get above the 10-day, because then the bears can trigger a sell-off. So this is a very, I mean, if you look at since this bottom, this is the first 2 days where we have been below the 10-day moving average. So this is interesting. Whatever you do, of course, you want to let the trend be your friend.